Advanced Financial Modeling, Topic 10, Investment NPV, IRR, and Capital Budgeting. References from Benninga include chapters 1, 4, and 6 on NPV, cash flows, and Excel functions. Learning objective number 1, we're going to compute the investment unlevered and levered cash flows. So we're going to use this example, a Caribbean condo. In March 2020, a particular Professor G went to Aruba after Penn State canceled its planned global immersion trip to Vietnam. While in Aruba, COVID struck the US, Penn State went remote, and Professor G booked a second week in Aruba. While in Aruba, Professor G found out the condo he was staying in was selling for $750,000, which seemed kind of expensive at the time. However, in March of 2021, Professor G returned to Aruba during COVID times. The island was open, but a lot of restrictions, and that condo is selling for $605,000. The question is this a good enough investment? Should he go for it? Should he buy it? So here are the specs. This unit is, you can see from this picture here, it's called the Blue Residences. We're talking about this particular unit right here. Here's the view from the window at the time of Airbnb. So the Blue Residence Complex are 3 buildings, 120 units. The unit is on the 3rd floor of the 180-degree views of the ocean. It is 3-bedroom, 3-bath, 1,600 square feet, and it's $605,000. That's $378 per square foot. And other comps on the ocean are selling for $500 a square foot. The condo has an established rental program, meaning when you're not there, it will be listed on Airbnb and Vrbo and other sites. And however, you have to pay 32.5% of all rents to the management company. So that $605,000, that would include also you have to pay $446,000 in closing costs. That's a $650,000 total due at closing. That 605 is going to be broken down of 575 for the building and 30,000 for the furnishing, since it's fully furnished. You would depreciate the 575 plus the closing cost over 30 years, and depreciate the furniture over 5 years. It is estimated that the only working capital needed would be $15,000 in cash that would be deposited at purchase in a checking account, and that would be used to pay monthly bills. So that total investment would be $666,000. That's the $605 asking price plus $46,000 closing costs plus $15,000 of working capital would need to be raised. At the time, there was $200,000 in equity to invest. So that means they would have to borrow $466,000, and there is an arrangement to borrow that amount at 3.5% for 30 years. The operating revenues and expenses. So there's $24,000 operating expenses per year. That's $12,000 in HOA fees, $8,000 in utilities, insurance, and real estate taxes of 0.6% of the value of the property, or about $4,000. In the first year, revenues would be half of what normal levels were, and then return to normal is the assumption. Income taxes would be 35% on any profits. However, in this case, there'll be no negative profits. When we talk later about corporate investing, we allow negative taxes. And when we do corporate examples later, we'll allow negative taxes. All that means is if a particular investment is losing money in a corporate world, you would assume that the overall corporation is positive. Therefore, you could shift losses to other parts of the business and have negative taxes. We'll assume a 10-year holding period. So we'll just assume that the condo is held for 10 years, then sold in year 10, paying off the loan. And we'll assume a real appreciation of the condo at 2.5%. We'll not allow any allowances for any kind of damage due to hurricane, since Aruba is south of the hurricane belt. And we'll assume no growth in operational expenditures or revenues. So we'll assume zero inflation, which is equivalent to saying we're going to do it in real dollars. And the starting year will be 2022. So here are all our assumptions. Most of them we just mentioned up here. And also here's the breakdown of the revenues. Of the 52 weeks in a year, there are 3 weeks high season. The condo sells for rents for $5,800 per week, and we assume an occupancy rate of 45%. And if I take the 3 weeks times $5,800 times 45%, you should expect rents of $7,800 in the high season. And then for the mid-season and low season, $27,000 and $39,000. So normal years, $74,000 in gross revenue before that 32.5% management fee. But during COVID, we'll take half of that until the island recovers. So let's go to the spreadsheet. We're going to go ahead and calculate the income statement and then the free cash flows for the condo investment. So going to the spreadsheet, again, you can see all the assumptions are up here in this orange type color. And we have down here the pro forma or forecasted income statement. So let's start in year one, which would be 2022, with the gross revenue. And it's going to be half of the normal year and that's 37,000. And then normal years, we're going to be 74,000. I'll anchor that and carry that across. Let me shrink that a little bit. There we go. Net revenue, and that's going to be the gross revenue minus the 32.5% management fee. But again, you always want to link everything back to the assumptions. So I'll take gross revenue times 1 minus the management fee, which looks like it is in D3. Anchor that. And so what an owner would expect to receive are these amounts here. And now operational expenditures. Operational expenditures are going to be, we'll anchor all this, the $12,000 in HOA fees. That would cover the general maintenance of the building, the security, the front desk, and the pool and pool, gym, and spa. Plus $8,000 in utilities. That would be mostly electricity and water and cable and Wi-Fi. And 0.6%, anchor that, times the value of the condo. That would be the real estate taxes. So we would expect to spend $23,630 per year. Copy that across. Condo depreciation. We're going to depreciate. I'm going to equals open bracket. We're going to depreciate the 575, anchor that. That's the building value of the condo plus the closing cost, and divide that by 30 years as an approximation. So $20,700 per year. But the furniture, which is going to be listed on the bill of sale of $30,000, we're going to depreciate that over 5 years. So just divide by 5, and then only carry that out for 5 years. That's $6,000 a year for 5 years. All right. That allows us to calculate our EBIT. EBIT, again, you can always start a cell with plus or equals. It's going to be the net revenue minus OPEX minus condo depreciation minus furniture depreciation. So you're going to lose $25,000 in the first year, and then in that last year, your making looks like about $6,000. Now, interest. Remember, the condo total investment is $666,000. That's the condo's price plus the closing costs plus that working capital. There's $200,000 available to invest. That would be the equity investment. So $466,000 would be borrowed at 3.5%. So that's annual payments of $25,000 for simplicity. And then here is a loan schedule that's been computed for borrowing $466,000 for 30 years. These are the first 10 years, showing the beginning balance, interest payment, principal payment, ending balance. And then notice at the end of the 10th year, you owe $360,000. So that last payment, assuming that the condo is sold in year 10, would be the last principal payment of $12,000 plus the ending balance of $360,000 for the total payoff. So the interest component of that schedule, I'll just put here, interest. And then I can calculate EBT, earnings before tax. So now I have my EBIT minus my EBT, losing $40,000 the first year. losing $7,000 in that last year. Now taxes. So we're not going to allow negative taxes. So we'll say equals if EBT is less than 0, taxes, comma, are 0, else taxes are EBT times the 35% tax rate. Anchor the 35%. So what that allows me to do is if this number ever turns positive, it'll be 35% of that number. Otherwise, it is 0. But looks like it's never, you never pay taxes. And then my net income would just be EBT minus my taxes. Okay, well, things are looking pretty bad right now for the condo. Remember, these are income statement net income numbers and not cash flows. Remember, the main difference is that depreciation is a fake expense, but also the income statement doesn't include the CapEx or working capital. So we did make all these adjustments. So there we go. That's our first exercise, is to calculate net income of this condo. We're now going to move on to calculating the free cash flows, the unlevered cash flows. We'll call them FCFFs, free cash flows to the firm. We're going to start with an assumption that there's no interest and no debt to calculate these unlevered free cash flows, and which means we're going to take the EBIT after tax, which means just taking the interest component out, and then we'll make these other adjustments. So going back to the spreadsheet, coming down here, we're going to have a link to EBIT after tax, but that's not so clear cut because remember, EBIT can be positive or negative. And I had this problem with taxes. If EBIT is positive, I have to pay taxes. And if the EBIT is negative, there are no taxes. So what I'm going to say is equals if EBIT is less than 0, EBIT after tax is equal to EBIT. So you can see that formula. If EBIT is less than 0, EBIT after tax is EBIT, else it is EBIT times 1 minus the tax rate of 35%. Anchor that tax rate. All right, so if EBIT is less than 0, EBIT after tax is EBIT. So there are no taxes. Otherwise, it's EBIT times 1 minus the tax rate. All right, we'll copy that across. And now we'll do our CapEx and resale value. How much do I need to spend today? Well, my CapEx, I'll put a negative, is going to be the 605 minus the closing cost. So that's the condo building value and furnishings minus the closing costs. So out of pocket is 651. And then how much do I get if the condo sold in 10 years with a 2.5% appreciation? Well, notice I have a schedule here. It's like a little balance sheet here. Here's my cash, by the way. I'm going to put $15,000 in account and then withdraw it in year 10. Here's the condo's book value. It's going to start out at 621, and then it's going to be reduced by the annual depreciation. Here's the condo's market value, 605, and then it's growing by 2.5% a year. So within 10 years, you expect the price to be 774. However, you have to pay 5% commission on a sale. So I take 95% of that final value. So you expect to get 735 in 10 years. So what's the resale value? After tax, 735 minus taxes on the 735, which is minus the capital gains tax rate, 20%, times the difference between the 735 and the net book value. Because according to the IRS, you're taxed on the difference between what you get for it and when you sell it, minus the net book value. So you'll be taxed on that difference between 735 and 414. So after tax, I expect to get 671 in 10 years. Depreciation, we can add up the depreciation, we can add the two depreciation numbers from the income statement. So I can take furniture and building, Add those two together. Minus changes in net working capital. So here's my net working capital over here. The first thing I can do, I need to spend $15,000 on net working capital. And then I'm going to subtract changes. Notice it doesn't change until you get to take the money out at the end of year 10. So I can just make this a formula if we want. Say minus the change minus the change in net working capital. And what it does, it just makes this number down here go to 15,000. And there are my unlevered FCFFs. I can just sum these three numbers together. Whoops. Equals sum. So it's going to cost me $666 today to buy the condo. And then when you look at free cash flows, it's going to generate $1,000, then about $26,000 a year. And at the final one, I'm going to make $711,000 if everything goes according to plan. So these are the FCFFs, the unlevered free cash flows. The cash flows if this condo were bought with cash, no debt. And then lastly, I'd like to show you the levered cash flows. Levered cash flows just start with net income. Make these exact same three adjustments that we just made for unlevered cash flows, which are CapEx, resale, depreciation, and working capital, but make one other adjustment, and that is the loan payments. So even though I'm spending $666, I'm borrowing $466, but then I'm paying off the principal of the loan, and then I'll have the final principal payment of the loan here. So the unlevered free cash flows, I spend $666 today, assuming, whoops, go back to the spreadsheet, assuming I'm financing this all with equity, and then I would make a little bit of money to $25,000 about, and then $711. However, levered free cash flow is only $200,000 out of pocket, and then it looks like it's kind of breaking even most years, but you make some money here in year 10 when you sell this. But you got to pay off the loan. That's the difference between, this number up here, the 711, and this 327. Mostly it's the fact that you're paying off your loan. All right, so these are the free cash flows. Then the question is, how do we summarize the analysis? But before we do that, let's talk 1 minute about FCFFs and FCFEs. FCFFs, unlevered free cash flows, and FCFEs, levered free cash flows, are both important insights into any investment. All right. They both include operating profits, which are revenue and OPEX, taxes, CapEx, and investments in working capital. Both of them account for that. However, FCFFs exclude debt and interest. FCFEs include the effects of debt and interest. So why have both? Well, FCFFs, those unlevered free cash flows, allows you to evaluate an investment without the effects of debt financing, which could change over time. So it's nice to actually just look at a business and say, how's the business cash flow is going to look, regardless of how I finance it, or not regardless, just if there's no financing. And FCFEs, though, are very important as a small business owner. What actually comes out of my cash flow given my exact loan. So they're both important insights into this decision. All right, now how do we summarize our analysis? Well, we have all these cash flows, but we can't just add them up over time because of time value of money. So what we need to do is have a couple metrics to help us decide if this is a good investment. So the next topic, we're going to talk about what are those metrics, and they're going to be NPV, IRR, and payback.